Okay, on the tax issues, so now we're assuming that the captive is up and running. Can we actually get a deduction for the premium that we pay out of our operating company for the coverage? That's what we're talking about here. And really, you have two requirements in order to get a deduction. You have to, the coverage has to be ordinary and necessary. So in other words, are these risks that it would be ordinary and necessary to cover? Now, this is a really gray area, so anybody looking for a fine definition is not going to get it. But I think this is also why you want to be thoughtful about who your captive managers are and also the types of coverage that you're writing. So the more esoteric types of coverage you think that you need, the further away you're probably getting from ordinary and necessary. The more you can stay with the tried and true coverages that are available on the open market, the better. And that's generally what we're looking for and what we're trying to do. So that way we have that way we're much closer to ordinary and necessary. And I'll give you an example. This is an example that's never happened to me before, but it's just a sort of an anecdotal story. Picture a company like the guy who has the captive in the U.S. with no outside the U.S. operations, no outside the U.S. employees, no outside the U.S. customers, no outside the U.S. suppliers, et cetera, et cetera. No reason to ever leave the country except to go on vacation. Imagine that he buys a kidnap and ransom policy. You'd have to ask yourself, what's the ordinary necessary justification for that? There probably isn't one. So that's probably a deduction that could be denied. We're not trying to look for that. We're trying to look for a good, strong relationship between the company's operations, the company's business purpose, and the coverage that's being purchased. The other thing we have to be is real insurance. You can't buy fake insurance or self-insurance because that's not deductible. And in order to have real insurance, you have to have two things. You have to have risk sharing, which means you can't just cover the risks of your own company. And we'll get in, I'm going to talk about that in just a second. And the other thing you have to have is risk shifting. You have to be moving certain risks off your balance sheet onto the balance sheet of the captive. So let's say you have a risk for a loss of key customer. You have Bob Scarlatta, who's going to come talk in a couple of weeks about his thoughts about private equity and applying those theories to private business owners, is in the M&A business. He has a sale going on right now where basically he has a very successful business owner, but the business owner only has two customers. They're both very large customers. They're very profitable, but if one of them went away, it would be a disaster for the business. So there's a perfect candidate for loss of key customer coverage. Somebody who has 1,000 customers and the loss of one isn't going to mean anything, it wouldn't be a very good opportunity for coverage. But for this guy, it's a great opportunity. So he can move that risk off his own balance sheet to some degree over to the captive, who can then insure that loss of key customers. So I'm just trying to give you a picture of how that really works. In terms of risk sharing, this gets a little bit technical and a little bit complex, but the basic idea is that you need to, your captive, in order to be successful, has to insure the risk of other companies. There are two pieces of authority in this area. There's a case called Harper that basically said if your captive has 30% unrelated risk, so in other words, if you have $1 million of risk, if you have $300,000 of risk that you're covering from some other company, then that's enough. Not too long after the Harper case, the IRS issued a revenue ruling in this area that basically said if you have 50% of unrelated risk, so that's you're insuring some other company's risk, and it's 50% of the total risk that you're insuring in your captive, then you're in their safe harbor, so you're okay, you're covered, you're allowed, your insurance, which is what we're looking for. Now, for most business owners, the idea of okay, I get it. I see why I need to cover someone else's risk and, frankly, why they need to cover mine. But I don't have the time to go out and find all these other companies. What do I do? Well, there are basically reinsurance pools in the marketplace in all different areas of insurance. I mean, not just in captives, but there are reinsurance pools that are put together with lots and lots of companies. For example, one of the pools that we use has, I think, 120 or 130 companies in it. And they're basically in the business of helping captives meet this 50% test. So what they're essentially doing is they're trading risk. So you're putting 50% of your captive's risk into the pool, and you're taking 50% of the pool risk onto your captive's balance sheet. So this is how you're meeting this 50% test. Now, what this really means is that the pool could have a loss, and in fact, some pools do have losses, and all pools have different loss experiences. But you know, I would say every pool has some loss experience. And so what that really means is that you could actually lose some money here. And it's important to tell your clients that they could lose some money. Different pools have different ways of helping to stop the risk of loss here. So that and these are commonly called stop-loss policies. I'm not going to go into it in much detail today. But the idea is that the pool offers for a cost. So again, when we do our costs, we build in all this stuff so the client can see what the total cost is, not just the cost of operation. But the pool sells essentially a reinsurance policy or a stop-loss policy that limits the amount of actual loss. So anybody who's interested in that, follow up with me after the call. But there's basically a way to limit to a reasonable level the amount of exposure that you have to pool risk. But nonetheless, it still has to be there. There has to be real exposure. And you have to meet this, or you want to meet this safe harbor test, and this is the way it gets done. So if you have risk sharing, if you have a adequate risk sharing and you have risk shifting, then you have real insurance, which, just to go back to my slide, in order for your client to deduct the premium, has to be an ordinary and necessary expense to the business, and it has to be real insurance. Okay, that's from the company side. So if your client is operating a business, that's all they care about. They got coverage, they paid a price for it, and they got a deduction. That's what they're looking for on their operating side. On the captive side, what we're looking for is no tax on the premium income. So when premium comes in, it basically goes to reserves. It's not taxable. But if you don't have any claims, or if you have low claims, the difference between your claims, in other words, how much you paid out and how much you took in, is profit. Okay, so if you have $1.2 million coming in premium income, and let's say you had a claim for $100,000, you would have $1.1 million in profit, which normally, because normally in C corporations, that would be taxable at the corporate level. And whether you're operating inside or outside the U.S., you're going to be taxed as a U.S. company. So that means you'd have a substantial tax at the captive level. So you'd have to say to yourself, what, am I crazy? Why am I getting a deduction on my operating C corp and paying premium over to the captive, only to have to pay the exact same tax at the captive level? And the answer is, well, you're not crazy, and you would never do it. So you say, well, okay, well, what's stopping that from happening? And the answer is, there's a section in the tax code, and you can go look it up. You type in 831B into Google, you'll be able to see the code section, and you'll get zillions and zillions of articles about this whole thing. 831B of the code basically says, if you're operating as a small insurance company, which means you have less than $1.2 million in premium income, that's why that whole $1.2 million is a magic number, then you don't have to pay tax on your profit, provided your premium income is less than $1.3 million. So in my example, you had $1.3 million in premium income, you had $100,000 in claims, you had $1.1 million in profit. As long as you've properly made your election, which is simple to do, you're not going to have to pay tax on that premium income profit. So that's why people are doing this. In order to do this, again, you have to elect to be treated as a U.S. company under this code section, which is 953D, which basically just says if you're a non-U.S. company, you can always elect to be taxed as a U.S. company, which you would say to yourself, well, why would I do that? And the answer is because if you don't do it, then you have to pay excise taxes, which are things you want to stay away from. You're subject to backup withholding and all sorts of other things. So you definitely want to be treated as a U.S. company because you can take advantage of the other section that says even though you're being taxed as a U.S. company, you don't have to pay tax on your premium profits as long as you're under $1.2 million. So you know, it's counterintuitive a little bit. You want to be taxed as a U.S. company, and you want to take advantage of that special section. Now, in order to be taxed as a U.S. company, you basically just have to make the election, and in order to make the election, you have to have significant assets in the U.S. equal to 10% of your gross income. You could do it by a letter of credit. Typically, that's not the way it's done. It's typically done by actually having assets in the U.S. So how does that work? You open up a bank account in the U.S. When your capitalization comes in, it comes into the bank account in the U.S. When your premium dollars come in, they come into a bank in the U.S. And so practically by default, you meet this test because all of your assets, not just 10%, all of your assets are in the U.S. Okay, I think that's enough about that. We've talked about this 831B election. Again, when you file the tax return, you're just going to elect to be treated as a small insurance company. As long as your premium is under $1.2 million, you qualify. And as I said earlier in the program, you still have to pay tax on your investment income, so your underwriting profits are reinvested. They earn tax, they earn dividends, they earn capital gains, they earn whatever they earn. They're still going to be taxed. Remember, this is a C Corp, so it's a flat tax, 35%. You don't get any benefit from any of the other, breaks in taxes.